Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. We're inside the 1 minute mark before the markets actually close. And as you can see here, we are still trading on the lows. The markets have been getting pummeled throughout the day, and you can see here this is an intraday chart. The sellers have been absolutely relentless. And if you look down to the left here, you can see that's my target price of $413.44. We're not far away from that. I do believe that we're going to hit that on Monday, and then we'll have to see whether or not this support level down here will hold for next week. So again, still keeping that downside target. We're literally pennies away from that, and we'll have to see. Looking at IWM as we're coming into the close right here with 1 second left. There you go. The markets are officially closed on this Friday, March 28th. You can see the downside target right here on IWM that I had set at 201.06 has officially hit. And if you look down below, you can see that the volume is increasing on the way down. So what I'm going to do is just continue down to this support level down here. So my new target for next week is going to be 198.32. We had a question come in from Luis on last week's market report, and very nice comments that he's put there. He says he's literally watched every one of our Wednesday and Friday videos, and he's learned so much from the technical analysis. His request was that I go through a more thorough training on how I determine my price target lines, sometimes down to the pennies. As you can see here, I highlighted that for you. And basically, Luis, the lines that I draw are basically mimicking previous up and down legs. You'll eventually find out if you become a regular member that I tell our members to look to the left as you draw to the right. And you can see that as the markets move up and down, we call these legs. Here's an up leg right here from this low to that high. Then we have a down leg from here to here, then another little mini up leg and a down leg. You see how it more or less oscillates. And what I do is I look at the previous angles. So let's take this angle here, for instance. I am mimicking that angle there because that's just the way the markets have been trading. And whether you're looking at a major market ETF or an individual stock, it tends to follow previous price action in the chart. So I also look at the number of days in each leg on average. So you can see here, this was 3 days, this was 5 days, and we already have 5 days here, and I'm just going one more day to forecast that. So I keep the angles, and while I don't always hit the targets to the penny, I hold myself accountable to those targets being hit to the penny. And so a lot of them come really close, like diamonds came real close, and understand that 82.2% of the time I will hit my targets. And that's based on years of monitoring the price action and the targets that I establish. And what that means is that 17.8% of the time, I'm not going to hit the targets. Yeah, of course, I would love to be 100%, but no one in the world is 100%. So that's how I do it. And thank you so much, Luis, for asking that question. And yeah, by the way, keep those questions coming. Folks, I really appreciate that. And I do my very best to keep up with every single question and comment. And it takes me a lot of time to do that, but I will absolutely do it for as long as I possibly can. So again, I appreciate that. It helps drive the algorithms on YouTube and get us on the menu. All right, moving along to QQQ, you're going to see pretty much the same thing. Markets getting smacked. We did hit that downside target right there of 470.16. Look at that increase in volume. So next week, I do believe that the Qs are going to drop below that support level. And you can see down below that the CCI is still heading lower. The reason I'm not going too much further on that target is because the CCI down here is already slightly oversold. So it might go a little bit more oversold, and then I think we might see a bounce. So next week, QQQ, I have my target there at 463.42. And by the way, when we were talking about those price targets, you see the little box that pops up? I don't put those numbers in there. I just draw the lines, and I really don't take the time to try to get that lined up with any, even number or whole number. I just put it there, and whatever's in that box is what I keep for the target. All right, so looking at SPY, here we go. We came very, very close. The target was 554.66. The low today is 555.07. So what do we got there? About 41 cents from hitting that low. I'm going to extend that a little bit further because look down below. Today, the CCI crossed below the zero line. And when that happens, you generally get 2 to 4 more days of price action in the direction of the cross. So for SPY, the downside target is 551.51. All right, now I want to talk about the VIX. Here we also hit the target. Now the VIX for the most part is inversely related to the S&P. And go back and listen to my Wednesday report, and you'll hear me talk more about how I thought that would move back up to this moving average, and it has done that. I think the VIX is going to go slightly higher again Monday and Tuesday, and then I would expect a little bit of a pullback because I think the S&P is going through an ABCD pattern. We'll have to see if we get to that lower D. I'll talk a little bit more about that in a moment. So my new upside target for the VIX is 2278. I know a lot of our viewers and members are trading the VIX either through VXX or UVXY, and several of you have mentioned your success in trading those, and congratulations, keep up the good work. The volatility index is not as easy to trade as you might think. It's a little bit easier to trade it on the downside when we get these hard pivots, but the upside, you have to understand with the instruments that I just mentioned, they have a decay feature to it. So over time, they just basically erode, and then they get to a place in time where they have to do reverse splits to keep it over zero. Nonetheless, it can be traded. I personally don't trade. Maybe once in a rare while I'll trade UVXY or VXX, but I don't promote it because you really got to know what you're doing and how they function and what the risks are. So if you do that, please check out the risks. Now, if you look at the longer term charts here with the moving averages for the S&P, this is the S&P 500 ETF SPY again, you could see that right here, let me zoom in, you could see the blue line is my 20 period moving average, the green line is the 50, and the red line is the 100 period moving average. The 20 is already crossed below the 200. When we get the green line or the 50 period moving average crossing below the 200 period moving average like this, you're going to get what's known as the death cross. And I think that will happen towards the end of April, maybe even in the last week of April. And if you look at IWM, it has already gone through the death cross. That's just a common term that I've mentioned before, that the 50 being the green has crossed below the 200. Now that is my main reason why I'm officially calling the beginning of a bear market. Understand that a correction is 10%, a bear market would be 20%. We're not quite at the 20% for the S&P. But if you look at the price action, let's take IWM as an example. You have a basic channel that we had at the end of the bull market or the top of the uptrend here. You see that? And that channel was resulting from the price oscillating within that price range. But now what's happened is we have lower highs and lower lows also in this price channel. So the entire channel has shifted to a downward trend. And that's why I'm coming out early to mention the bear market or the beginning of the bear market. Again, look at the channel here. You could see it's a very long and pronounced channel. You see that? Do my best to draw those lines straight. And now we have lower highs here, followed by these lower lows. So here's the channel pointing lower. Now, no one else is going to stick their neck out like that and tell you about the bear market that's about to happen here or about to be confirmed. But if you look at SPX and you go back, and I mentioned this quite a few times, I do believe that we are duplicating what we saw at the end of 2021 and into the bear market of 2022. You see, this is what I'm talking about right here. That was the bear market that lasted a year, and then we reversed and the channel went back up, right, in the uptrend. We are, if you look back in time where we are here with the moving averages crossing, this is pretty much where we were in equivalent back in 2022. You see, and that's why back here, I had already called the top back here in 2021, and then we proceeded into that bear market. Now, if you remember back in the last quarter of last year, I did call the topping pattern back here. You might remember I would say it over and over again. I said I'm not calling the high, I'm calling the top, and that was the topping pattern that was forming. And you could see that even though I was early, and I did state as such that I was early, we did see the actual top, and now we're seeing the complete breakdown of that bull market. And so we are most definitely heading lower, in my opinion, based on 43 years of technical analysis experience in the markets. I believe that we're going to see a pretty severe bear market. And so as a result of that, you absolutely must, and this is with a capital M, must learn how to manage risk. If you don't have any risk management skills or haven't developed any strategies for managing risk, now is a very good time to learn that. We offer that 15-day trial period with no strings attached. Many of you have come to us through that free offer. We had a webinar last night where I told all the trial members to make sure they go to StickyTrades University and look at all the videos. One of the most important videos that we have in there is the 1% rule for managing risk. I use the 1% rule. And basically what you're doing is on each and every trade, you're going through a simple math calculation to determine what your risk per share is, and then you take your risk per share, divide that into your risk amount, which is 1% of your account value, and then that shows you how to properly size the position, right? If you don't do that, the market is going to punish you. I can't say it any nicer, because I've seen so many people get hurt because they're not managing risk. And this is what I'm doing. I'm showing you how to read the charts, but I'm also showing you how to trade, and using the proper technique with risk management, it takes the stress off of you. So that is it for this week. Thank you so much for liking and sharing and subscribing to our channel. It really helps us quite a bit. We are growing like crazy thanks to all of you. I appreciate that. And you have a good rest of the day and a great weekend. We'll talk to you next time. So long.
In a world of endless data, where every second counts, introducing Nod Live, your professional compass in the chaos of the stock market. Nod Live cuts through the noise. Stay ahead with Nod Live.